All righty, check, radio check. I want to welcome everybody back to Chat with Chris. We missed the last couple of weeks. I had a partners meeting, was able to get away and get a little bit of sun. What I didn't realize is that we were out of the country, we were in the Bahamas, but apparently we planned the trip because we were becoming limited on where we could go, and it was spring break. And I don't know how much relaxation I actually got because 2 or 3 in the morning, kids running up and down the hallway didn't equal rest and relaxation. But I'm back. It was still good. Keith and I went. We were able to do a couple dives. So if you're friends with me on Facebook, you can look at a couple of dives we did. So that was fun. For those of you that have not been on this call before, we've been doing this since COVID first hit. It's been almost 2 years now. And, it's a way for me to sort of stay in touch with clients and the community and people that have maybe are interested in what's going on in my perspective. I was doing classes at Rutgers Business School. I'm actually in conversation with them now to maybe restart that now that COVID seems to be lifting, easing some of their policies. So hopefully I can get back to some semblance of normalcy. But in the meantime, until that does happen, and I don't know how that will actually look in the future, but I'm still going to attempt to try and do these on a regular basis because I think that, from the feedback I've been getting, people find this valuable because it's not emotional content and we're not trying to sell you anything. So we're not sitting back and pushing a product. Basically, I touch base on ideas and concepts, help you to understand how they work. And then if it's something that maybe you want to explore further, you can certainly do so. I'm also a partner with a nationwide organization called the Eagle Team. And sometimes some of them or the advisors that are under us will invite their clients to this. So, we take a very holistic approach and just offer guidance and maybe a little comfort level as you're approaching the markets. So one of the topics that we tend to do every month is a rear view mirror approach, looking at what has happened in the past. So although this says March 2022, this is actually data from February. And since this data has come forth, you will start to see, the war in Ukraine, obviously, I think has a lot of us disturbed and concerned. And what does that mean for not only the world globally, the people that are actually experiencing this horrific attack on our country, but, what does this mean for our markets, for investments, for retirement, all of these things. So it's a very complex arena. And one of the things I've always viewed my role is to be the voice of emotional stability. Let's not make knee-jerk reactions. The market will make knee-jerk reactions. But if you have strategies in place, we can start to look at signs and say, hey, how should we proceed? Should we maybe adjust some things that we're doing? So that's the purpose of today's call. And I have, 6 or 7 slides that I'm going to go through. The first is a monthly snapshot of equities. So when we look at equities, right, one of the things that we're going to see here is that we have the S&P, which is a red line. The Russell is a blue line. You have European developed countries is a teal, or I'm sorry, that green line, neon green. And then you have undeveloped countries, which does include China, in pink. And then you have commodities, real estate, and lastly, you have gold. So, notice that the two areas that have done well for the month is commodities and gold. And typically that's a sign of flight to safety. But I do want to emphasize 1 month does not a market make. So we have to, although we can sit back and play Monday day quarterback and go, I should have been here, I don't think it's really a complete picture, right? If we come back and we look at now for the year, now we're into 2 months, we can still see that the markets have been under pressure across the globe. And that does include Ukraine, right? And Russia's invasion. So we know oil's going up, which is why that index or the commodities are heavily weighted with oils and futures. So that's why we see that there's a lot of profit to be made there. Real estate, though, which was all the rave, you see that a lot of the real estate is actually lost money. So it was starting to go on a tear. I still think property values, I was listening to a show the other day and they were talking about that, housing prices, although interest rates and the Fed did go up a 1/4 point, and it's likely that they will continue, Inflation is here. They have to curb that. But I think we're going to see a unique scenario, which is property values are in short supply, which drive prices up. Rents will continue to stay high. Where it will be problematic is for new home ownership into the future. People can't afford some of these expensive houses and borrow the money. If they have the cash, if they have the savings, then yes, maybe they can take advantage of relocation, or maybe even some of the profit taking and downsizing. But for right now, real estate is not something I'm overly thrilled with. But the S&P and the small caps, the red line and the blue line, are also at the bottom. And but it's not awful. I do believe in from what I'm hearing and I'm watching closely, I think we are heading towards a recession. But I know I've said it. I said earlier this year that we would probably start to see correction territory around June of this year. We're not there yet. We're still showing, and jobs data came out today and economic data came out today, and the markets had a good day. We will continue to see this whipsaw action. It's unsettling. My advice typically for clients is don't sit and stare at your accounts every day. Also, don't listen to the talking heads. Remember, the news needs news. So I can no sooner wake up and look at my clock at 9. I wake up at 5, by the way, but I'll look at my clock at 9:30 when the market opens, and it will inevitably state whatever the futures are, right? It's up, it's down, right? They need something to say. You have to take a step back, relax, and realize that everything's going to be okay. Right? Especially the clients that I work with, we have strategies in place. Everything's not going to go up all the time, but the bottom's not going to fall out. We have some signals here that you're going to see on the next one that we are watching. But the equities market is the bottom trigger. When these three lines cross over, my point is that this chart, there's a lot going on here, but we're looking for something called the triple cross, which means all three indicators, triggers, have crossed over into warning territory. When that happens, a red line will appear here, right? So this happened when COVID hit, and then it got better. A lot of clients, everybody panicked, not necessarily our clients, but America in general, was, hey, what's going to happen? And the markets did correct. But a lot of the advice to our existing clients was stay the course. That is still our advice. But there are, as you can see, there's some approaching into equities. There's a crossover here. And this one here, the bottom one, the MACD, moving average convergence and divergence indicator, has also approached a crossover. So we are watching. Like I said, I do believe that we will start to see some pressure put on equities. So what does that mean? Well, if you're in a strategy and you're not retired today and you have time, okay, there's no need to panic. But if you're in traditional 401k at work, if you're in your 403b at work, if you're traditional IRA, maybe you don't have a strategy. And maybe it's time to start to think about what can we do to be defensive, to take some of this risk off the table. And that's things that we've talked about before, and we will continue to talk about on a go-forward basis. So right now, the good news is the sky is not falling. We are watching, and to be just a little careful, equities is not my overall concern. What is my concern is the income markets. So this is February, right? And you have the aggregate US aggregate bond market. You have the high yield corporate bonds is blue. So red and blue US, right? Then you have T-bonds, 7 to 10-year yields. And then you have the Vanguard total international bonds. Then you have treasuries, munis, and high yield munis. So, everything in the income arena for the month didn't do well. But again, 1 month does not a market make. So let's take a snapshot and look back. This is where we will continue to start to monitor, but I want you to think about this logically. When income portfolios are created, people have typically started to follow the traditional advice. They said, hey, listen, we don't want to be in equities anymore because they offer risk. Right now, there are strategies that you can be within equities and get dividends and what they call aristocratic stocks, and have some type of basket of stocks that may go up and down in value, but they're going to offer some type of income stream. And not everybody typically has either an awareness of it or an understanding of it or a comfort level for it, but it is a strategy that we will use. But a lot of people will say, hey, well, I heard bonds are safe and that's where I want to go. Well, the issue is, and we've talked about this in the past, is bonds don't like rising interest rates. So if you follow traditional advice and you start to approach retirement and you have, let's say, start to de-risk your portfolio by having, say, 60 or 70% bonds, you can see here by just this chart, following that traditional type of planning, you can start to see that it's actually your portfolio could go down in value. And it's not likely that that will ever recover, right? Because two things are happening. The income that these portfolios typically throw off, right? They throw it off. The consumer now takes that and needs that money to live on. And the example I've used in the past is, let's say you had $1 million portfolio. And I'm just to keep the math simple. Let's say that you needed $30,000 a year of income off of that. So that's a 3% yield off the portfolio. But if this here, as you can see, a negative 3%, well, now you've actually lost value in the portfolio. So let's say that now it's not worth $1 million, it's worth only roughly 900,000, right? 930,000. So you've lost 70,000. Well, 970,000 is not going to yield you the same 3% that you needed. And a lot of people just don't understand the mechanics behind that. So they turn around and they're actually, unbeknownst to them, following what I call sort of water cooler wisdom, are taking their portfolios and adjusting it based on theory, but not necessarily into the current economic environment, to say, hey, I want to be more in bonds because I heard they were safe. But in fact, they've actually increased their risk in the current environment that they're in. And therefore, a lot of their principal is now consumed. So just be careful with that water cooler advice. And then the last thing is, we're seeing here that we're right about, you see this is crossed over, this is crossed over. This last trigger right here is almost here. It's almost at the triple cross. And if we do that, then you're going to see this red line, and you will start to see if this happens. I do believe this will probably, like, as we continue to talk, I've been in talks with our investment team, and just getting information. Hey, has this happened yet? So that in anticipation, although we're looking at a month past, it still hasn't happened. But the word that I got was it's close. So that means that anything could set this off. A negative comment, further action by Russia, China, right? An expanse of COVID, any number of things could trigger this, right? We have inflation, we have oil costs, we're all feeling it at the pumps. I mean, there are so many factors going into this on a daily basis that we just have to proceed with caution. And this is why I cannot stress enough that you have to have strategies, right? What can we do to limit our downside risk? That is absolutely the conversation you should be having with me or somebody like me, to say, hey, what else is possible, right? Because, Warren Buffett's rule to investment: don't lose money. That's rule number one. And rule number two is, hey, when in doubt, follow rule number one, right? I know it seems so simple to say, but there are a lot of clients that I've put into strategies that have reduced their risk. Everybody's different. You can't follow your next door neighbor's strategy for your personal planning. So you have to keep that in mind as well. And then lastly, this is the RPA is the Recession Probability Analytics tool that was created. It was actually created by Formula Folios. It is on an upward tick, right? The last couple of months, we are not there. This black line is in the 50s, says, hey, listen, is a recession likely, right? This did cross over right after COVID hit, and it went up to 60 or 70, but then it came back down. We're watching this, but I have been noticing for the last 2 or 3 months a slow upward trend. Again, this is not going to happen overnight. We can relax, but just keep in mind that consumer spending is up, right? Things have been okay, but things are getting more expensive. And I've heard some alarming concerns just in regards to wheat, which could mean for global food shortage, right? So I don't have a crystal ball either, but I'm listening to data. I'm looking as well. I'm trying to help my clients understand, hey, listen, let's put together a plan and then move in a general course for our future. But it's okay to start to make course corrections. What's typically not advised is to make knee-jerk reactions, because you turn around and go, oh, the market's down 3 days in a row, let me get out. And many studies have been done that, humans in general make poor emotional decisions when it comes to investing. We get out at the wrong time, we buy at the highs, and we sell at the lows, right? So it's just completely opposite from how to make money from a long-term perspective for investing. So, this is Chris Lesser, Professional Planning Services. This is our disclaimer, right? Investment advisory services are offered through Retirement Wealth Advisors. That's my RIA. But I do want to thank you. But if you have questions, shoot me an email. Give me a call. My phone number, 732-302-1810. Happy to answer any questions. If you want a second opinion on what you have, happy to do so. So again, it's good to be back. If anybody else, again, if you're on the call, you're a client of mine, great to see you. Thanks for joining. If I've not met you yet, I look forward to speaking to you in the future. Have a good day. And again, thank you very much. Bye-bye.